Welcome back to the deep dive. We've been looking at a significant volume of, well, highly technical financial documents recently,
Mm.
and they all center on one specific group, retirees,
Right.
especially those living in, or, maybe thinking about a move to Florida. The sources detail the 2025 tax law changes, and these are not minor tweaks.
No, not at all.
They contain some critical deadlines and, frankly, some massive opportunities. Our mission today is to cut through all that noise, help optimize your financial strategy, and really maximize your retirement dollars. Okay, let's unpack this.
It's the right time to do it.
The changes we're looking at affect both federal retirement accounts and the state-level advantages. For anyone planning, understanding how these two landscapes intersect in 2025,
It's crucial.
it's the difference between just retiring and, truly thriving.
That's absolutely right.
Yeah.
As we navigate the end of 2025, the timing here is just so critical. We've seen major federal shifts, particularly around required distributions, and this is the big one, the looming sunset of those high estate tax exemptions.
Right.
So for Florida retirees specifically, knowing how to stack these federal changes on top of the existing state benefits, well, that's the core of effective wealth preservation.
So let's start there. Let's start with Florida's foundational benefit, the zero state income tax.
Yep. The bedrock.
It's the bedrock of planning for anyone moving there, and it remains rock solid through 2025.
It's the ultimate trump card for retirement income. I mean, when you look at how retirement accounts are taxed,
Pensions, 401k.
all of it, pensions, 401k, traditional IRAs, they all face federal tax, of course.
Yeah.
But in Florida, they face zero state-level tax.
And that bypasses what can be devastating state taxes in other places.
Oh, absolutely. You're talking 6, 7, sometimes over 13% in places like California or New York.
And when you actually put a number on that saving, the impact is, well, it's stunning.
It really is.
Based on the sources, if you're a retiree withdrawing, say, $80,000 a year,
Pretty typical number.
Florida's advantage translates to tax savings of anywhere from, $4,800 to over $10,000 per year.
Every single year, depending on which high-tax state you left behind.
And if we project that out over a typical 20-year retirement,
The numbers get huge.
the savings can comfortably exceed $200,000. I mean, that is not just a vacation fund.
No. That's years of stability, or it's your long-term care stability built right into your plan, just because of your location.
And that advantage is even better this year, isn't it? Because of a change to property taxes.
It is. It's enhanced by the enhanced homestead exemption.
An inflation adjustment. It sounds so technical.
Yeah.
But practically, what does that mean for a retiree on a fixed income, say, 5 or 10 years from now?
It provides essential future proofing.
Yeah.
So the standard $50,000 homestead exemption, that stays.
Okay.
That lowers the assessed value of your home for property taxes. But the enhancement for 2025 is that this exemption now automatically adjusts with inflation.
So it keeps its value.
Exactly. As property values and living costs go up, the real monetary value of your tax protection also increases. It ensures that benefit doesn't get slowly eroded over time. It's quiet change, but it's hugely effective for budget stability.
Okay, so with the Florida advantages secured, let's pivot to the federal landscape. Because here's where it gets really interesting. This is where Congress determines the deadlines and opportunities we're facing right now. We have to talk about two major changes. One impacts your current income, the other your legacy.
Let's do it.
Let's start with the immediate benefit for those who are charitably minded. The increase in qualified charitable distributions, QCDs.
Right. The IRS has made this tool dramatically more powerful for 2025.
How so?
The annual limit for QCDs, and this is directly from an IRA, has increased to a pretty substantial $108,000.
Wow, $108,000.
Yep. And this primarily benefits retirees who are age 73 and older.
Because they have to take RMDs.
Exactly. Required minimum distributions. If you are philanthropic at all, this is probably the most tax-efficient tool you have available right now.
And the advantages are layered. It's like a powerful triple benefit, isn't it?
It really is.
First, the QCD counts directly towards satisfying your RMD. Second, and this is key, the amount you donate is not included in your taxable income.
You never see it, so the IRS doesn't either.
And third, you get this tax advantage even if you don't itemize your deductions. which is a big deal for a lot of Florida retirees.
A very big deal. Many have paid off their homes, so they don't have that mortgage interest deduction anymore. This makes the QCD a universal benefit.
We saw a great example on the source material. Let's say your RMD is $45,000, but you only need $30,000 for living expenses.
Right.
You can donate that other $15,000 directly from your IRA. Your RMD is satisfied, and you have $15,000 less added to your adjusted gross income.
Which can protect you from other things, like higher Medicare premiums. It's precise income control.
So that sounds amazing. Is there a catch?
There is one. I wouldn't call it a catch, but a critical limitation. This only works directly from an IRA.
Not a 401k.
Not from workplace plans like a 401k or a 403b. So for people who want to truly maximize this, a smart first step is to consolidate those old plans into a single IRA.
Okay, so QCDs are great for income planning today, but let's look at how the government is changing the rules for assets you want to pass down.
Right.
We need to transition to the final Secure Act RMD regulations. They fully took effect in 2025.
And this is a major, major connection point to your estate plan. The final rules solidify that controversial 10-year withdrawal rule.
For most beneficiaries who aren't a spouse.
Exactly. Adult children, grandchildren, inheriting a retirement account.
We've heard the term devastating used for this rule. Why is forcing a 10-year withdrawal so damaging to the heirs?
The problem is compression. That's the word to remember.
Compression.
Before this rule, an heir could stretch distributions over their own lifetime. Now, the full balance of that inherited IRA has to be distributed within 10 years of the original owner's death.
Which means the income is compressed into just a decade.
Right. And that can push your heirs into much higher tax brackets. They're basically getting slammed with a decade's worth of income and the taxes that go with it all at once. This completely changes how you need to structure your beneficiary planning.
That compression on inherited IRAs is stressful enough for heirs. But for high net worth Florida retirees, there is a much more urgent, much higher stakes deadline demanding attention right now.
Yes.
This is where the clock is truly, truly ticking as we close out 2025.
This is, I would argue, the most significant piece of tax legislation looming over wealthy families right now. We're talking about the scheduled dramatic reduction of the federal estate and gift tax exemptions.
And this is set for the end of 2025.
At end of 2025. It's a sunset provision from a prior law.
Can you just lay out the numbers for us again? Detail exactly what we stand to lose if action isn't taken this year.
Sure. Right now, the exemption is approximately $13.6 million per person.
13.6.
Per person. Meaning you can gift or leave that amount in your estate tax-free. If you're married, that's over $27 million.
Okay.
However, on January 1st, 2026, the law says that this exemption will drop by almost half. It's going to fall to roughly $7 million per person, adjusted for inflation.
That's a massive drop.
It is, and the immediate implication is crystal clear. A very narrow year-end window to use the current nearly doubled exemption. It is a classic use it or lose it situation.
So if you make a gift this year under the high limit, they can't come back later and tax it.
That's right. The IRS has confirmed no clawback. Gifts made under the $13.6 million exemption are safe, even after the limit drops.
So you can lock in that massive leverage right now.
Exactly. It lets ultra-high net worth families transfer significant wealth tax-free before December 31st.
The sources list several very technical strategies that high net worth individuals should be discussing with their teams, like yesterday.
Yeah, these aren't simple transactions. These are complex tools for large wealth transfers.
We're talking about annual gifting, of course, but also more intricate things like grantor retained annuity trusts and dynasty trusts.
Right.
For our listeners, what's the practical utility of these tools in this specific sunsetting environment?
Okay, so think of them as ways to multiply the use of that $13.6 million exemption. A GRAD is particularly useful right now.
Why is that?
Because it lets you shift appreciation out of your estate tax-free. You lock in the current, lower value of an asset today, you transfer it into the trust, and any future growth. It just avoids the estate tax entirely.
And it doesn't eat up much of your exemption.
Exactly. It consumes minimal or even none of it. Then you have dynasty trusts.
These are for multiple generations, right?
Precisely. In the context of the sunset, you can transfer a very large chunk of wealth into a dynasty trust under the current high exemption, and that wealth can then pass down through your family for generations, completely sheltered from future estate taxes.
It really is a once-in-a-generation planning opportunity.
It is, and it's one that will not come back. Before we move to our final strategic checklist, let's just quickly review a few other 2025 Florida-specific updates, just to round out the picture.
Good idea.
A key one is the commercial rent tax repeal.
What's that about?
Effective October 1st, 2025, Florida is eliminating this tax on commercial leases. Now, this isn't relevant to every retiree.
But for some, it could be a big deal.
Right. If you have commercial real estate investments or if you started a small business post-retirement, this lowers your operational costs. It's a nice little bonus.
What else?
Florida also updated its conformity with the federal tax code to January 1st, 2025. This is mainly administrative, but it helps align state and federal tax treatments. It just makes filing returns a little cleaner.
Okay.
And finally, some small savings through extended sales tax exemptions. They've made the back-to-school sales tax holiday permanent every August.
Which is nice if you have grandkids.
It is. And they extended exemptions for data centers. Modest, but, every
Yeah.
bit helps.
Good to see the state keeping its framework streamlined.
Yeah.
So what does this all mean? Let's get to the strategic moves. Based on everything we've covered, if you're a retiree in Florida, what are the 4 immediate actions you should prioritize?
This is the checklist.
Number 1, review estate plans and accelerate gifting immediately. For high net worth individuals, this is the siren call of 2025. You have to urgently finalize any major gifting or implement those sophisticated trusts, the jurats, the dynasty trusts, before that high $13.6 million exemption window slams shut.
You absolutely cannot wait on this.
Number 2, maximize your QCD opportunities. If you're charitably inclined and you're 73 or older, use that higher $108,000 limit. It's a powerful way to both satisfy your RMD and reduce your taxable income.
A great dual strategy.
Number 3, optimize withdrawal sequences for conversions. Because Florida has 0 state income tax.
It's the perfect environment.
It's the absolute best environment to execute a Roth conversion. Converting traditional IRA money to a Roth is a taxable event federally.
But not for the state of Florida.
Right. You save thousands you would have paid to states like Massachusetts or Oregon on that conversion. Leverage that 0 state tax now.
It's a huge opportunity.
And finally, number 4, update beneficiary designations.
So important given the 10-year rule.
Exactly. Because of that 10-year rule, you need to review all your retirement account designations. Maybe consider splitting accounts among beneficiaries or naming specific types of trusts to get more control over the distribution timing.
Which can minimize that painful tax hit on your heirs.
Right.
Looking ahead, the sources did point to some potential future legislative discussions.
Oh.
Yeah, there's proposed federal legislation that could eliminate income taxes on Social Security benefits entirely, nationwide.
Wow. Now, Florida already doesn't tax Social Security.
Correct. But a federal elimination would provide additional relief across the whole country and just further cement the tax advantages for all retirees.
That's something to watch.
And let's just reiterate the value of Florida's tax advantage in one crucial, non-negotiable area, healthcare. The absence of a state income tax means a larger, undiluted percentage of your retirement income is available to deal with those critical and, let's be honest, rapidly rising health-related costs.
That stability factor is huge.
In a long retirement, that enhanced stability is often worth more than any single tax break.
So our concluding advice is this. The key is understanding how these specific 2025 changes affect your unique financial blueprint.
Your specific situation.
Whether it's the QCD increase giving you charitable freedom or the ticking clock on the estate tax exemption forcing you to act. This knowledge is only powerful if you actually implement the strategies while these benefits are still available.
That's the bottom line.
Successful retirement income planning isn't just about understanding the latest tax law. It's about implementing sophisticated strategies that align perfectly with your personal goals, your risk tolerance, and your family's circumstances, all while taking advantage of every single federal and Florida benefit available.
It requires thoughtful, immediate planning.
And the time to start is right now. We'll catch you next time for the next deep dive.